Hi everyone, it's Tayo here from MediReach and welcome to episode 3 of Pharmacy in Finance podcast. And I'm here with Prajesh again. And we're going to kick things off talking about building wealth and future planning. So let's take it to talking about tools and systems. What sort of tools can you recommend for someone who wants to stay on track of their finances?
This will be the third time I mentioned it. Budgeting app. A budgeting app will be a very solid tool to encapsulate all your finances. So I personally use You Need to Budget.
Okay.
And I asked ChatGPT on recommending budgeting tools and it recommended 15.
Wow.
And You Need to Budget wasn't one of them. So, there's a lot more.
A lot more, yeah.
Now, the thing is, all of them are going to have different functionality and different features that some and others may not have. But I think a key one is making sure that in terms of a systemized process and an automatic process happening in the background of a budgeting app pulling in transactions from the bank and the credit cards, because that will really help you budget a lot more easily. So, for example, when I spend £15 at Marks & Spencer, the very, very first time I do that, I manually categorize it as groceries. Now, every time I spend on at M&S in the future, it will automatically just put it in groceries for me and ask me to approve it as well. Now, something like You Need to Budget and these more comprehensive apps, you can keep a track of all your different investment pots rather than keeping it in a spreadsheet, which can get messy. If you have different credit cards, different investment pots, stocks and shares, ISAs, pensions, so forth, keeping it all in one place will help you track things more easily, like your progress towards savings goals and also your net worth, for example, or having a snapshot or over time of your assets versus your liabilities, making sure that's going in the right direction.
Yeah.
So a budgeting app is certainly crucial, but when it comes to investments, you won't be able to do that directly through a budgeting app. And you need to use a different system for that called a platform, an investment platform that has the regulatory permissions to hold your money and then invest it. So there's many out there. I like simple ones like Moneybox for beginners because it really holds your hand when it comes to setting up an ISA and for a pension as well, for example, and also recommending you what fund you should be investing in aligned to your risk profile. Platforms like Hargreaves Lansdown Trading 212 I've not used, but from my understanding, it's a lot more DIY approach. You need to be a lot more sophisticated in your knowledge before you go into those types of systems and platforms.
Okay.
But yeah, generally speaking, a good solid budgeting app, which will typically set you back £10 to £15 a month.
Yeah.
But well worth the investment. And then a investment platform so that you can make your investments.
Fantastic. So let's talk a bit more about budgeting. So how much should we really allocate to, your rent, your mortgage, eating out? Can you give us a guide on how you would decide how much to spend on each, section of your budget?
Yeah, I can definitely allude to a rough rule of thumb. Generally speaking, from person to person, it will vary. If you've got a low income and you're starting out in your career, you're going to be spending more on your everyday expenses as a percentage. But if you've got a much, much higher income, then it will be a much lower amount, the everyday expenses, as a percentage of your income. So it does depend from person to person. But if you need a starting point, perhaps following the 50-30-20 rule is a good starting point. So allocating 50% towards your kind of future you or your savings goals, 30% to your everyday expenses, 20% towards your lifestyle expenses or your wants, shopping, restaurants, and so forth.
Okay, fantastic. All right, let's talk a bit more about building wealth. So what kind of investment strategies would you recommend a pharmacist use who, doesn't want to spend, a lot of time managing their money and, checking their investments?
Yeah, rather than investment strategies, because it's very difficult to beat the market, you definitely want to live by, I'd say, investment principles instead. So some core investment principles are things like focusing on the long term and not the short term. So if you look at the markets over a short period of time, you will see it's very volatile.
Yeah.
Over a much longer period of time, you won't see that volatility. You'll see long periods of time where it's going up. Perhaps with blips, where the financial crash, for example, where there is a downturn, but generally speaking, there's an upward trajectory.
Yeah.
And there's economic reasons for that. For businesses that list and fail, fall off the market, but businesses that list and profit and grow, stay on the market, and their value grows as well as other companies up and down the supply chain. So you want to benefit from that and invest for the long term, not the short term. You want to take a diversified approach. So don't put all your eggs in one basket. Don't invest all in crypto or Tesla.
Yeah.
Take a broad approach. And as I'd mentioned before, historically the best performing asset class over the last 140 years has been global equities.
And is that the one you would start off?
For long-term investments, yes.
Yeah. Okay.
As long as you can afford not to touch it for at least 4 to 5 years. Because the risk with global equities is that you invest and let's say you haven't properly made your plan, you don't have enough cash for short-term needs, and then you need to draw on your global equity investments within the short term, and the worst case being that there's a market downturn and you're drawing it on it at that time, which is the worst time to draw on it. So if you've got a long-term goal, a goal that you are saving for that is beyond 5 years, then you should be looking at global equities as a core of your investment strategy.
Okay.
Now, would you put all your money in global equities? It depends on your risk profile. If you're kind of a medium and even a lower risk investor, you might add something called fixed income to the portfolio, which is an asset class that sits between equities and cash. So it's not as low risk as cash, and it's not as high risk as equities. It's essentially in the middle, where the structure of it is that rather than investing into a company, you are lending money to a company, and they, in return for that, give you a interest rate for that lending. But if you invest in the fund, then there's many different types of companies, and again, companies, industries that you're being exposed to. So you'll have a percentage allocation towards equity and fixed income. Now, if you've got a medium-term goal and you're medium risk, let's just say, you may have a portfolio that's a mixture of the two. But if you've got a goal that is very much long-term, you're going to have you should have a lot smaller percentage in that fixed income. Okay. Because you can afford to take the investment risk with global equities. And then you would have that the next step beyond that is wrapping the investment. So the two core ones there would be a stocks and shares ISA, of which you've got a £20,000 allowance. Use it or lose it, so you can't carry forward from previous tax years if you haven't used it. And a pension, which is a £60,000 allowance, or your earnings if that's lower. If your earnings is higher, there's potential to carry forward from previous years, and you do get tax relief on contributions too. So yeah, in terms of strategy, it's certainly putting in place the chess pieces of your wealth, emergency fund, cash ISA for short-term needs, capital requirements in the next few years, 5 years and beyond. Medium-term pot would probably be a stocks and shares ISA, a pension, which kind of overlaps with the stocks and shares ISA if your long-term goal is you still need access before 57. Okay. Pension is very much long-term because for certain people, especially in our age bracket, 2 to 3 decades is very much long-term. Yeah. Stocks and shares ISA, pensions sit in the medium and long-term buckets, and the underlying investments is the global equities, global fixed income.
How about your buy-to-let? So
Yeah.
I think in the UK, we have this thing where, we love property. And I feel like because you're getting your rental income and the benefit of the capital appreciation, I think that's the sort of investment strategies that I see people wanting to go into first.
Yes.
What are your thoughts about the property space at the moment?
Yeah, I really
versus stocks.
Yeah,
as well.
I really dislike property. I think because I mean, on the one hand, I dislike it for myself, but I really like it for my clients because it means my clients have got plenty of issues.
Yeah.
Plenty of tax issues that they need to pay me to help them solve it. So, yeah, it's certainly a love and hate relationship. But as an investment, property is certainly one you can consider because, like you said, you're going to get a rental income from an asset that is going to or should appreciate. And I appreciate outside of London, you're going to have higher potential for capital growth.
Yeah.
And certainly higher rental yields too. But number one, you're restricting yourself to one asset class in one country as well. So you're beholden to tax changes and market changes in one specific place, the UK.
Yeah, and regulation.
And regulation. And the thing is, I mean, look, there's a couple of problems in the UK. I think the biggest one is that there's a shortage of housing.
Yeah.
And the other problem is that there's not enough kind of first-time buyers or property owners. There's too many landlords and people renting. So there's not enough housing and the housing is too expensive. Okay. And if you just look at the history of tax changes over the last 10, 20 years, you can no longer write off mortgage interest in
Section
full.
24, yeah.
You only get a basic rate tax deduction. There's certain protections now for tenants. You can't easily kick them out.
Renters' right bill coming into effect next year.
Yeah. If you look at the history of this, it's all moving in their direction against landlords. It's not for landlords. So,
but could that change? Could that tide change? Because as you see, rents are going sky high because over the past few years, a lot of the landlords are exiting the market. So people are looking at it as an opportunity to buy properties.
Yeah. Well, it doesn't change the underlying issues of supply shortage and the government's overall stance, and this will be across different parties of there's still too many landlords. There's not enough first time buyers. We're in our 30s. We don't own property yet, but our parents had house prices of appreciate their income was very different, but as a percentage of their income, house prices are astronomical right now. So the government's position is not going to change on that. And just looking at it as an investment vehicle, like I mentioned before, there's income tax, capital gains tax, inheritance tax, and stamp duty land tax when owning and running a property portfolio. Whereas stocks and shares, ISAs, and pensions do away with a lot of those tax headaches.
It's true.
There's also a lot more flexibility and much less headache when it comes to running and managing investments. So if you needed £5,000 or £10,000, rather than completely redoing your mortgage and releasing equity or having to sell a property, you can just draw that down from investments. Instead of having to deal with the tenants that may be causing you issues or paying a lettings agency to manage that for you, nobody's going to cause you headaches with stocks and shares investments.
Yeah.
As long as you adhere to those investment principles. And, when you get to a certain level of wealth, engaging an advisor as well, you're going to have a lot of that headache completely taken off you. And I will personally, it's very unlikely that I'll hold property in my investment portfolio because having a stocks and shares ISA, a pension, and once I've used that up, things like investment bonds and general investment accounts, which are still more tax efficient than than property. And generally, the growth rates of both property and the stock market have broadly been the same, without taking into account tax inefficiency. When you take into account tax inefficiency, the return on the stock market has been more than property. And I wish I could quote this study, but it's in our Investing Wisely guide. You can download it if Teo leaves the link.
I'll leave it. Don't worry.
But we wrote some pages on there about investing in property, and there was a study done in America of comparing stock market returns against property, and stock market returns have been a bit higher than property investments. And like I said, that doesn't take into account the tax inefficiencies and the fact you need to run and manage a portfolio and then engage an advisor like me to help structure it so that it's can pass down tax efficiently. I come across all the time now clients that even that have 2 or 3 properties, and they're facing potential inheritance tax liabilities of £300,000-400,000 up to £1 million sometimes, depending on the size of their portfolio. So having an investment portfolio structured in a clever way can mitigate a lot of that.
Yeah.
And that can't be easily done with property.
Okay. So your attitude towards commercial property, is that different? And I think this is quite important for pharmacy owners because, they would have to eventually, buy the commercial space that they're operating from.
Of course. Commercial property is an investment. It's the same because it's still subject to very similar taxes, inheritance tax too. In terms of a pharmacy owner owning a commercial property because they're running their business from it, very different scenario. So, there's a couple of scenarios there where they could pay rent for a commercial property. I know some medical professionals that do that, but also owning the actual underlying property. That certainly gives some opportunity in terms of you can actually hold that commercial property in something called a small self-administered scheme, which is a pension attached to the company. So that gives certain advantages in terms of holding that commercial property in a tax efficient manner, but also, the certainty of having a business run from a property that you own as well. So holding it as an investment versus owning it where you run your business, 2 very, very different scenarios.
Got you.
But certainly one to be explored on a case-by-case basis.
Fantastic. Let's go on to talking about financial independence. So, there's a lot of talk, people want to retire, much earlier these days, especially as, the retirement age just keeps increasing.
Yep.
What sort of steps would you recommend a pharmacist take to, get to financial independence and, finding that early retirement spot for themselves?
Yeah. I think one exercise you can do right now is start to work out how much you need to reach financial independence. So the way you want to approach this is take an income that you want to have during your financial independence. So let's just say it's £30,000. You take that figure and you times it by 20 or 25. Just to keep the numbers simple, times by 20, that's £600,000. So what that means is that you need to build a pot of £600,000, and that £600,000 pot you can safely withdraw 4%, and that will equal the £30,000 income that you need. Did the numbers work on that? So 6 times 4. I think it's slightly more.
Yeah,
it's slightly more. But essentially, the exercise is that you're building a pot that you can draw an income from.
Mm-hmm.
Then what you want to attach to that is what age do you want to achieve that by? And of course, when you start adding on the layers, it can get a bit complex. You may want to engage an advisor at that point to do cash flow planning. But you're going to have different sources of income. You may still be working part-time, let's just say, or as a consultant when you reach that age. So you might not need the whole £30,000. And I think the £30,000 and the £600,000 figure works quite well, because the idea is that during your financial independence in the later years, you have this pot that is invested in ISA, pension, whatever wrapper it is, but is the underlying investment is in global equity and global fixed income.
Yeah.
And it's giving you a 4 to 5% return. And when you're taking that income, that 5%, which equals £30,000, then that £600,000 is lasting you for 2-3 decades.
Yeah.
So in terms of the financial independence piece, that's how it works. Pot of money giving you an income that you can safely withdraw on as long as it's invested and managed in the correct way as well. And in the meantime, what you want to be doing is building up towards that lump sum and using growth and the stock market and time to your advantage. Because £600,000 sounds like a lot.
It does.
It is a
huge
lot.
number.
It is a huge number. But you've got time on your side. And as Einstein said, the eighth wonder of the world is compound growth.
Yeah.
So really utilizing that compound growth of the stock market, which if the stock market, because the stock market, the S&P 500 has returned 10% a year since the 1920s. You know, and if we're conservative and we use a 7% growth rate, as long as you're contributing a monthly amount 2 to 3 decades, it doesn't actually work out to a significant amount.
Yeah.
And just bear in mind as well, in your later years, as you earn more, you can put more towards that.
Okay. And staying on that point, how would you divide how much you invest into your private pension and your stock and share ISA account then?
Yeah, it would certainly be a different answer for different people, because if your financial independence age is 60, that's when you want to achieve independence, then, you know, putting most of your money in your pension makes sense, because you can access the pension after 57. But if the age you need it is 50, then it will be a balancing act between stocks and shares and pension, because there's a 7-year gap between 50 and 57 where you can't touch a pension. So you need to use the stocks and shares ISA. But after 57, it's 55 at the moment, but it increases to 57 in 2028. So during that 7-year gap, you need to be relying on the stocks and shares ISA. You can only rely on the stocks and shares ISA.
Yeah.
So to actually put numbers, pounds and pence on that, it would require cash flow planning, and that will be different for everyone, depending on the income requirement, the age chosen, the different events that also happen leading up to that event, because there might be a large drawdown in a few years' time for a few years when children go to nursery or private school, whatever it may be.
Okay.
So I can't give a hard and fast answer on that.
So let's say you wanted to retire at 50 then. What proportion of your money would you say, like 80% towards stocks and share ISA, or, you know, is there...
Generally speaking, you'd find that most of it is in the pension.
Yeah.
You would find that, as a rough rule of thumb, perhaps 30% is in the stocks and shares ISA. The rest of it is in the pension. Because when you look at 50, there's only 7 years until 57.
Got you.
But then 57 up until average life expectancy is another 3 decades after that. So all of that time you can rely on the pension, and therefore it should and will be a much bigger percentage compared to a stocks and shares ISA.
Okay, fantastic. Thank you so much.
Thank you, Teo.
No problem. And that's it for episode 3. Make sure to tune in for episode 4, coming real soon. Thank you, guys.